Good evening, everyone. We're just going to wait a few more seconds, perhaps a minute, as the attendees stream in, and then I'm going to kick off. All right, good evening, everyone. Thank you very much for joining the weekly forum. This is a time when Smartkarma Plus subscribers get to have an open conversation and discussion with us on some of the key ideas that we select across the platform to share with you. This is meant to be a two-way discussion, and it's meant to be experiential. So during the course of this webinar, I will actually switch a lot of tabs. I will show you things on the platform itself. I will refer you to certain presentations. And the idea is not only will you see the ideas and sort of discuss them with me, but also get to understand how Smartkarma brings them together and presents them to you. So maybe just very quickly touching on the agenda, I'm going to give you a very brief introduction to the forum itself and some of the key rules that we follow in this session. After that, we will dive straight into three key things. We will look at Straits Trading, which is a Singapore listed small cap. We will then look at Nintendo, which is a Japan listed mega cap company, very large company. And then finally, we will look at an emerging thematic that Smartkarma is very excited about, which is the growing hydrogen economy in Asia. So let's kick it off. So let's talk a little bit about the forum and the format of the forum. So first of all, we select ideas using a very objective data-driven framework. So at Smartkarma, we're very blessed to have thousands of users that touch our platform and use it every single day. By tracking how users are utilizing the information on the platform, what they're engaging with the most, we develop some very unique insight into what sort of ideas would be most interesting to discuss with you. So that's very important for you to know, because this is not just what I think would be an interesting thing or what somebody else thinks would be an interesting thing, but these are ideas that are selected using an objective data-driven criteria and based on some proprietary platform data that we gather. Why are we doing this? We think this is quite an exclusive backstage pass that we can bring to private investors who are now joining us on Smartkarma Plus. It is an opportunity for some to learn how different independent research providers look at investing. And it's also a time for us to discuss and ask questions and learn from each other, not just from what's on the platform. And lastly, but importantly, just a little disclaimer, we are bringing these ideas and this information purely for informational purposes. The idea is not to offer investment advice. Also, this is opinion of our insight providers who are writing this research, and not my opinion or anyone else at Smartkarma for that matter. And finally, Chatham House rules apply. So what I mean by that is, please do not post this information on social media or any public forum without express permission. Finally, I am happy to take questions from you at any point of time. On your Zoom application at the bottom, there is a Q&A button. You can just click and send a question at any time, and I will sort of pause and take it. So let's dig into the first idea. So I think every week what we will try and do is to feature a small company, a large company, and a theme. So this week, we're going to bring to you Straits Trading. Now, some of you, at least those who are based in Singapore, you might have heard of this company because it's nearly 100 years old. It's a very, very long-standing business. And historically, they have done a bunch of things. They've been involved in trading. They've been involved in real estate. But today, as it stands, Straits Trading is mostly a real estate platform. And through this platform, they own a bunch of very, very interesting assets. and there is one particular highly valuable asset that they own, which the market is unaware of or is completely ignoring. And that's what makes Straits trading a very compelling idea. The asset that I'm talking about here is a stake that they hold in ARA Asset Management. And I'm going to describe this in a bit more detail to you. And we see a very specific catalyst happening in the next 12 to 24 months, which is the IPO of this particular asset. So ARA Asset is currently a private company, a very valuable private company. And in the next few months, ARA Asset will come to market. There will be a big IPO. And then the world will realize that they could have owned Straits Trading and had exposure to this very interesting and valuable company. So before I get into the meat of the idea, I want to show you a few things. First of all, on the right-hand side, just a little share price chart. You will notice that, for most of the last year or even 3 years, the stock has traded between $2 and $2.50. This year, COVID came along and the stock got slammed. The little green circle, maybe it's a bit too small, but there's a little green circle towards the end. That is when one of our research providers, whose name is David Blennerhassett, he picked up on this particular idea and wrote an insight. So maybe I can sort of flick and show this to you. So this is Straits Trading on Smartkarma. And if I just click on David's name, you will see, you will notice when he published, this is around here. I think the stock price was just shy of $1.60. The market cap was just shy of 400 million. Okay. And you can look at this research piece quite easily. He spoke about Straits Trading as a company that was ripe for privatization just because it was just so incredibly cheap. And this is what his research piece looked like. It was the 19th of October. And it was very, very soon after the first half results of Straits Trading that he chanced upon this opportunity. This is a detailed piece where he actually explains why this is interesting. And as I was mentioning, this is a company that began all the way back in 1887. So this is not a new company. They've been around for a very, very long time, and they do some very interesting work. So let's look at it briefly. So Straits today have 4 or 5 very interesting businesses. So the first segment that they operate in is real estate. They own a platform called Straits Real Estate Private Limited. Then they own a stake in ARA, which used to be a listed company in Singapore up until 4 years ago. So 4 years ago in 2016, there was a large privatization, $2 billion deal almost, where a big private equity firm called Warburg Pincus got together with a few other investors and privatized ARA Asset Management. They also have exposure to Suntec REIT, which is an office REIT here in Singapore. And then they have exposure to hotels or a hospitality business under the Far East brand. And lastly, they own a smelting business, or 54% of a tin smelting business in Malaysia, which is also a listed company. So that's their exposure, right? And I think the crux of the story here is this 22% stake in ARA, and I'm going to talk about it now. So 4 years ago, Warburg Pincus and other shareholders paid close to $2 billion to privatize ARA. At that time, ARA had $30 billion of assets under management. Today, 4 years on, ARA Asset Management has $110 billion of assets under management. Even if you don't know how to value it, quite simply put, you can see that the assets under management have grown nearly fourfold, and valuation in this particular space has only increased over time. So very roughly put, ARA should be worth at least 3 or 4 times what it was back in 2016. So today, just even on the back of an envelope basis, ARA Asset Management is a $6 or $7 billion market cap company. And by the time they come back for its IPO next year or the year after, we think it could be worth even more. So 22% of a $6, $7, or $8 billion company is about 3 times the current market cap of Straits Trading. And that's the hidden asset that we want to stress on. I'm going to switch. and I'm going to show you something interesting. Remember, I mentioned to you that David Blennerhassett picked up on this idea after the first half presentation from the company. So I've just opened that first half presentation, and I want to show you something interesting. So I'm going to search for the word NAV, the net asset value. So Straits itself tells you what is the fair value of the company or the NAV of the company every 6 months when they report their results. And in the first half of the year, they mentioned that their NAV was $3.56. Now it had decreased a little bit because of COVID-related issues. And at that time, the share price was $1.50. Now, what's quite interesting is that this NAV does not even include the full value of ARA, because Straits only owns 22% of ARA. So based on the accounting rules, it's not fully incorporated into the valuation here. And you guys can ask me more questions on this towards the end, and I can go into more detail. But very, very simply put, this is a very cheap company. It's trading at less than $2 today. I think it's about $1.80 where it closed today. So it is a very deep discount to its NAV, which also does not take into account the value of ARA when it will get listed. Now, let's look at a few other pieces of evidence, right? Let's go and look at, I'm going to just go deeper into this presentation briefly. And I would highly recommend that you look up this presentation, and I'll show you how easily you can find this on the platform as well. But let's go and look at the ARA section of this presentation in a bit more detail. Yeah, this is the money slide. So you will notice in 2016, which is when this company was privatized, they had about 30 billion of assets under management. And they had a 5-year target to reach $100 billion by 2021. But this year itself, by June of this year, they already exceeded their 5-year target and hit $110 billion of assets under management. So they are more than a year ahead of their targets, which is exceptional. Not many businesses can claim to be doing so well. And we think that the value of ARA has expanded significantly since the time it was privatized as a result. So this is really interesting. I think the other very interesting thing is somewhere in this presentation, there is a link to a news article where the founder of ARA himself mentioned about 1.5 years ago that he thinks that ARA is now worth between $4 and $5 billion. And that was about here when the company had 80 to 85 billion of assets. So it's very clear that we're on the right path by assuming that ARA's worth is now, 6, 7 or more billion dollars. So this is the crux of the idea. And you guys will receive this presentation from me later, and you will be able to click through, read these insights. I think I had also promised where you can find some of these presentations. So here on the platform, if you go into filings, you will see company filings. And this is where you can find all historical filings. So for instance, you can see that in July, when the share price was close to $1.50 or $1.60, the company was regularly buying back its own stock. So this is, this is where all exchange filings, including results, etc., are automatically collated for you. Okay. Great. Maybe I will now, I'll take any questions if you might have on ARA, or if you don't, then we will move straight into Nintendo, which is the second idea that we will discuss. Okay, I think I do have a question here. Okay, great. Just 1 second, guys. All right. Ashu, I think you can speak now. You just need to unmute yourself. Yeah, there you go.
Yeah, I'm just wondering, can you hear me?
Yes.
The half over half debt has gone up by 20% from 850 million to 1.1 billion, something like that. I mean, is it because I see they have some issuances in terms of bonds. But do you think their company has some short-term cash flow problems that they need to raise more capital for some of the
Uh,
projects?
That's a great question. Actually, if you again go back and sort of read the last presentation from the company, they highlight that they're actually seeing enormous opportunities to further grow the business. And meanwhile, the cost of debt for them has declined quite significantly. So
Right.
this is a company that has a lot of hard assets, and banks are very comfortable lending to them at low interest rates. So they're taking advantage of the low interest rates to raise money and expand more rapidly over the next year or so. So that's the reason. And actually, if you go all the way back to the start of this presentation, let me see. And I've got another question coming in as well. But very, very briefly, look, right at the beginning, they talk a lot about dry powder for opportunistic acquisitions. And there's quite a lot of detail on what those are in the rest of this deck. And I think they're just getting prepared for those, which would be very positive for the company. I mean, just to give you an example, their own internal real estate business has grown tenfold in the last 4 years, and the share price has not caught up with that. So I think there's a lot that this business is doing behind the scenes, which they want to accelerate further through cheap capital. Now, Ashu, I'll just quickly switch to the next question. Just wait a second. Hi, Pete.
Hey, Raj, how are you?
I'm good. Good to connect.
Good. Yeah, you too. Great. Yeah, interesting idea. Thanks for sharing. Just wondered if investors now. You mentioned maybe ARA come to market in 1 or 2 years. In the interim, how's the dividend yield and cash flow to support a holding period through that time?
So I think the first part of your question was how did they even end up with their stake? So
Yeah,
in 2006,
I don't know if I just missed the start of the call.
No worries. In fact, I didn't quite touch on that. So back in 2016, when ARA was being privatized, Warburg Pincus led that consortium. But Warburg were not the only guys who bought ARA. So Straits came in and bought 21%. I think Warburg took 40+%. And then there was a third investor, which was a Chinese group that took another about 20%. And in fact, earlier this year, that Chinese group sold their stake, and Warburg bought most of this, but Straits also increased. They went up from 21-something% to 22-something%. So that's the history. And ARA is run by a guy called John Lim, who also started Suntec, and he's very close to the Straits family, which is the T-City group. It's a large family office here in Singapore. And I'd say, I think the history is really fascinating. David covers a bit of that in his insight. And also you will find some of that in this presentation. And I think you can touch base with me on Smartkarma through messaging later, and we can discuss it a bit more also. But the bottom line here is that Straits have always had an inside track on big real estate transactions in Singapore, especially in the REIT space. They actually have a few listed REITs of their own. And ARA was a real darling stock in Singapore because it's a REIT manager. It's one of the sort of most defensive businesses, right? As long as the REIT exists and it has a certain AUM, they receive fees. And every time the REIT grows, they get more fees. So as long as the assets under management keep growing, they get an annuity stream. Now today, Straits itself pays a dividend. It's not huge. It's about just over 3%. However, I believe that ARA itself is not paying a big dividend right now while it's private. And the reason is because they are refinancing that money into buying more assets. They're extremely aggressive. There's at least 5 live deals where ARA is trying to buy up assets in the market right now. If you just Google the word ARA, go to news, you will see these deals. They're buying something in Australia, they're buying something in Korea, Japan, and they're buying a REIT manager as well. So I think they're not paying up a lot of dividends, and the shareholders are very, very happy with that because it means faster asset growth and a much bigger market cap when it comes for listing.
Yeah.
Okay.
Okay, great. Thanks.
Great. Now, guys, maybe I'll take one last question. I think it's a follow-on from Ashu. Ashu, I think you need to unmute yourself. Great.
No, I don't have another question. I'm fine.
Oh, okay, great. All right. Let's move forward to the next idea. Great. So this is very, very different, completely different flavor. We're switching gears from a small $400 million company to a $66, $67 billion market cap company listed in Japan called Nintendo. And I think I speak for everyone who's on the call today. If you've ever played Mario, you've sort of, or heard of Mario, then you would know Nintendo. This is a game we all remember very fondly from our childhood days. So Nintendo is a very exciting company for a very different reason. To me, anytime a large company like Nintendo decides to change its path or pivot into a new direction, it's worth noting, and especially for Japanese companies, because they tend to be very slow and sluggish in changing course. They believe that if something is working, you don't really change it. But Nintendo decided a few years ago to make some dramatic changes, and they're completely not captured in its share price at the moment. So let me share a few of those. So first of all, Nintendo historically never made games for the mobile phone. They only made games that you could play on their Nintendo consoles. But I think about 4 years ago, they decided to make its games available on the mobile phone. So of course, some of you might have played Mario for mobile, but I think a lot more of you would have played Pokemon, Pokemon Go. Pokemon Go is developed by a studio called Niantic, which is part owned by Nintendo and part owned by Google. So increasingly, Nintendo is now making mobile games, which makes them a lot more relevant to a lot more people. That's the first thing. The second thing is, as they're moving into mobile games, they're also moving away from just console sales as revenue to recurring revenue from the games, which is a very, very interesting switch. And the third big thing that they're doing is they're moving into what's called an IP licensing model, very similar to Disney. So they're starting to build theme parks in Japan, and they're doing a whole bunch of other stuff where the things that they create in their games can now be licensed out to collect royalty income. And that's very, very high margin business. And it's a great way for a company like Nintendo to build bigger, more lasting legacy. So this is a transformation that happens literally, like for instance, once in 40 years for a business like Nintendo. But when it happens, it completely changes that company going forward. And I'll give you one example of such a transformation. Microsoft. For those of you who might follow Microsoft, you would have known that for a very long time, Microsoft used to be a licensing model. You would go, you would buy a CD, you would install your Windows or your Office. And then they moved into the Microsoft 365 model, where we now pay whatever it is, $5, $10 per user per month. And as they moved into this SaaS model, software as a service model, the market cap of Microsoft has just gone ballistic. So Nintendo is doing something very, very similar in the gaming world. But now let's take a look at what the market thinks, because I think that's quite important. So let me switch to the right tab. Okay, so once again, I'm on the platform and I'm looking at the analytics section. So the first thing I want to point out to you is that Nintendo has a PE ratio of about 16. Now, for those of you who follow, big game companies or even big hardware companies like an Apple or a Tencent, you will realize that Nintendo is extremely cheap. A Tencent will trade at more than 30 times earnings. Even Apple, which is purely a hardware company at the moment, mostly is about 30 times PE. So this is half the valuation. The second thing that you'll notice is that the dividend yield is close to 3%. Actually, this number is wrong, because this is a historical number. these guys are going to pay much higher dividends going forward. And let me show you why. If you go into the tab called liquidity, let's look at leverage. Now, the pink line tells you the net debt to equity at the moment is about negative 0.8. When your net debt to equity is a negative number, it means that this company actually has net cash. So Nintendo is actually extremely cash rich. They're sitting on tons of cash and they're making tons of incremental cash flow. Let's look at that very briefly as well. So when you look at their financials, first of all, you will notice something quite interesting, that the margins have been expanding for the last 3 years. If I look at the same thing on a quarterly basis, let's look at, say, maybe the last 10 quarters, maybe even longer, 20 quarters. You will see a very steady trend in the profitability of Nintendo, which is important. If you look at just the last 5 quarters this year, you will realize that their profitability went very, very high. They made almost double the margin that they normally make, which is great. That shows you there's a lot of operating leverage in this business. And you will notice this, that year to date, in the first 3 quarters of 2020, they've already made more money than all of 2019. Now, for a business like Nintendo, that's very important because the bulk of their sales come in Q4, which is the holiday season, it's the Christmas season when people buy a lot of gaming consoles as gifts for each other. So 2020 is going to be a bumper year. They're also sitting on a ton of cash. Now, what does a company like Nintendo, which is listed in Japan, has nearly 0% cost of capital, do? I think they will either do a buyback or pay a big dividend or do a very interesting acquisition, or invest in something very exciting and bring it to the market. So that's the option value that really excites us going into Q4, which is a very strong period for Nintendo anyway. And look, I was telling you about cash flow. So this company already so far in 2020 has made 337 billion yen of free cash flow. This is after paying off dividends. And when you look at dividend growth, that has gone soaring as well. You have had huge dividend growth. And of course, 2020, the final dividend's not out yet, so this will not fully capture that. But if you go on a quarterly basis, they're paying big dividends already. So this is Nintendo, and I think just 2 key things for you to note beyond the idea. So our research providers picked up on Nintendo in December 2019. And the thesis was Nintendo is switching to an IP-focused business model, intellectual property-focused business model. And for me, it was the first line that really caught my eye. So Shigeru Miyamoto-san, who runs Nintendo, declared that he has Mickey Mouse in his sights. And a lot of traditional sell-side analysts just completely missed that remark. But that was the remark that got Miyamoto-san really excited, because that meant that Nintendo now wants to become Disney. And that is a transformation that is completely ignored by the market at the moment. Now, Nintendo will not be a 1-quarter idea, because big companies like Nintendo can take many quarters to change. But you're sitting on a huge margin of safety with that cash buffer and that cash flow. And you're sitting on a business which has tremendous operating leverage too. So there is a chance to make outsized returns with patience over a longer time horizon. So this is Nintendo. Once again, please feel free to ask any questions that you might have. Okay, looks like everyone is quite convinced on Nintendo, or maybe doesn't have any questions at the moment. Oh, okay, I think I've got something coming in again. Pete, I think you can ask a question now. Pete, I think you can ask a question now if you have one.
Sorry, I was on mute. Just a quick one. Is there any sense of this versus Sony? I've been reading a lot of interesting sort of sell side stuff on Sony, and I just wondered whether how this would stack up. I mean, the argument you've just made there looks very compelling. Just wondered if it would be more compelling than Sony, or whether you have a view on that as well.
Actually, Mio-san also looks at Sony, and he's very positive on Sony also. I think the difference between Nintendo and Sony is that there isn't a business transformation in Sony that we are excited about. Sony is much more about where it's in the cycle and how cyclically it's going to show better sales. And there is potentially some added upside if they start divesting some of the crappy businesses that they still have. Nintendo, on the other hand, doesn't have any crappy businesses, but it's really moving into a much higher margin, very high profitability, recurring revenue business model. So I think if you want to play a seasonal uptick, maybe Sony is a much more interesting idea. But I think if you want something that has a 2 to 3 year horizon with a lot of compounding built into it, then I think Nintendo would be more interesting.
Yeah, perfect. That's perfect. Thanks, Rod.
No problem, sir. Cool. Let's move on to the last item for today. Okay. This is really fun. So I think for those of you who've been chatting with me a bit recently, you'll know that I've been paying a lot of attention to what's happening with electric vehicles. I think this is an enormous theme, really big theme, where electric cars are going to replace the traditional combustion engine, right? And quite simply put, right, an electric car has an electric motor, and it has a battery, and the battery runs the motor, and the motor drives the car. That's it. However, there's a few countries and a few companies that do not agree with using batteries to power these motors. And these are countries and companies that feel that over the long term, batteries are very reliant on things like lithium. And there's only a finite amount of lithium in the earth. And they don't believe in aggressively mining our earth for lithium when there could be a better way to power the same electric car. So what these guys are talking about is the hydrogen fuel cell. Hydrogen, as you guys know, is one of the most abundant elements in the entire universe. Every star is made of hydrogen, water is made of hydrogen, most fossil fuels have hydrogen in it. So hydrogen is abundant, and what's very important also is that it has very high specific energy. So if you look at that little chart I've put on that slide, the specific energy to weight ratio of hydrogen is 40,000 versus lithium ion at 278. I think if you divide 40,000 by 278, I think you're going to get about 150 times. So hydrogen is about 150 times more efficient than a lithium ion battery. So that's the good news. The bad news here is that the supply chain to extract hydrogen and deliver it, put it in a gas station and so on is not really developed yet. But frankly speaking, even the electric vehicle charging stations are not that well developed yet. So the jury's out on, who really takes it in the long term. But as a theme, this is important. Couple of other things now. So which are these countries? So Japan is the #1 proponent of the hydrogen economy. They're making deep investments into hydrogen extraction plants, gas pipeline distribution, and also, endpoints for it to be consumed. Right behind Japan are South Korea and China. And now, very recently, Europe, Australia, and even some parts of the US, like California, are starting to advocate the hydrogen fuel cell economy. Amongst companies, the big sort of leaders here are the auto companies, especially in Japan. So Toyota has made huge investments, followed by Hyundai in Korea, and then Honda. Within China, Great Wall and SAIC are the two companies involved here. All of these are listed companies. Then after autos, you have the trading companies in Japan. Incidentally, these are the companies where Warren Buffett has recently taken a $5 billion stake. And the third group are companies like Iwatani that make cylinders, gas cylinders that are involved. Let me give you a sense of who Iwatani is, because you guys might have seen this company without realizing it. So if you guys have ever been for hot pot, or you've been to one of those steamboats or Thai mukata places, they bring a burner and they put it in the middle of the table. Next time you go to one of these places, have a look at the cylinder that's inside. It's almost, I'd say 80 to 90% chance that it will be made by Iwatani. And these companies are all supporting the hydrogen fuel cell economy. Lastly, with Joe Biden winning the election, I think I can say that now. He is also an advocate here. I think any alternate energy technologies that are clean and environmentally friendly are thematically in the right place. So there's a little video that I wanted to show you if we have time. But before I get into the video, I'll show you something. This morning, just this morning, is quite a coincidence. Bloomberg put out a massive theme piece on hydrogen, which looks a bit like this. Hydrogen is $1 trillion bet on the future, right? And they've actually announced a 3-part series. So what I'm talking about here with you guys today is something that is now catching the attention of all the big investors, yet very few are positioned. So let me show you Iwatani briefly. Let's go to the platform and just search Iwatani. Oops, 1 second. Sorry, didn't spell it right. Okay. This is once again a Japanese company. Now, let me show you what's happened to its share price in the last 2 months. So this is about 3,800 yen, and it's gone up to 5,500. This is not because the company has reported great results at all, but this is because, as this comment says, Iwatani has gone parabolic as the hydrogen theme picks up pace. So we think this is the start of a very, very fascinating theme. And the idea today was just to draw your attention to this theme. I probably, just in the interest of time, not going to show you the video today, but you will be able to access it through the presentation when we circulate it by email. But I'll be happy to take any final questions on any of the ideas or anything else for that matter. And then I've got just 2 or 3 very minor admin things to share with you before wrapping up. So over to you guys if you have any questions. Just raise your hand or use the Q&A feature and I'll put you on. While you guys might be preparing, just 2 or 3 things from my side. So the first thing is that this forum is very, very special because it's just for paying customers of Smartkarma. However, if you have friends who want to understand Smartkarma better, we actually organize 2 more webinars every week. You can actually see them straight from the platform, and you will also be informed in your emails every morning on what these are. So just as an example, we are hosting a webinar on the 8th of December with Far East Hospitality, and they're going to talk about what are the changes that hotels are seeing as we start coming out of COVID. Then on Friday, which is tomorrow in the morning, we're hosting a very specialist webinar on topics inclusions for small cap companies. So like this, every week we will feature guest speakers who are analysts, often with deep expertise in certain fields, but we'll also feature companies. And these webinars are open to any of your friends that you might want to invite, so feel free to share the links. This forum, however, where we unveil specific ideas is really just for subscribers. Because we're digging quite deep and we're spending quite a lot of time discussing these with you in detail. Okay, I think, let me see if there was a question here. Pete, did you have a question?
Yeah, sorry to interrupt again, but Iwatani, is that a pure play or do they have other things we need to consider
They are not a pure play. So their big dominant business at the moment is LPG. which are those cylinders that you buy and install into your steamboat apparatus. Hydrogen is still small for them. So there's a very, very good insight from Mio, again, incidentally, because he looks at autos, on what are the best stocks to play the hydrogen economy right now. One thing I will say is this is sort of much more a sort of a personal view, but I really like the look of the Japanese auto companies because they're growth cyclicals and we're about to come out of a recession and go back into growth. And some of the stocks are completely butchered, and they are amazing long-term franchises with great brand value. So I'll just show you one example. If you look at Mazda, so Mazda, the largest shareholder in Mazda is actually Toyota. And Mazda, interestingly, if I show you the 5-year chart, you'll be surprised. My computer tends to slow down when I'm sharing my screen. But look, Mazda's fallen from 2,500 yen to about 600 yen over the last few years. Its market cap now is less than $4 billion US. Just to put that into context, Tesla is now at $570 billion of market cap. Mazda's 3.8. And a lot of the Japanese autos will show very similar patterns. Most of them are trading well below book value. They don't have high debt. They've got very deep supply chains and extremely good distribution and very long enduring brands. They have derated because of two reasons. One is because people think they do not have electric vehicle technology. That is not true. A lot of them have models. It's just that they've been a lot slower in making propaganda and hype. But if you go through their presentations, they have the pipelines.
They have Mazda. I'm receiving already lots of information about their electric lineup.
Exactly. And the second thing is that they also commit a lot of dollar value to R&D, which means that whenever you have big shifts in technology, they will depress their own earnings because they're investing into the future. So I quite like that, and I think we're at a big cyclical turning point for growth globally, and very, very compelling valuation levels. So it's looking into 2021. I think you can play the hydrogen economy, recovery, valuation, consolidation, a whole bunch of themes through the Japanese automakers. But that's a topic for us to delve deeper into one of the forums in the coming weeks. I think there is one more question. Ashu, I think it's you. You're permitted to talk. Go ahead.
Hi, I've been following this hydrogen economy theme for a while, and I mean, there are lots of these companies trading on NYSE, NASDAQ, Canadian companies, and large companies like I own Linde, which is the largest producer of hydrogen in the world. I mean, oxygen and hydrogen. But I mean, has your research team or contributors looked at more ideas in China, A share market, who are somewhere in the hydrogen supply chain? Because there have to be some more ideas coming out of Asia, and I'm struggling to find them.
That's right. So actually, the insight here is on the Asian hydrogen economy. So right. Smartkarma tends to spend a lot more time on Asian companies, and so I will send this to you, and this is about stocks within Japan, Korea, and China that are involved here. Okay. Unfortunately, right here, right now, there isn't an exact pure play that is just hydrogen. But I think what will start to happen, this is my gut feel, some of these companies are going to spin off their new energy businesses or their electric vehicle businesses. And then you will start to see the pure play. So, it's a little bit early. This is an early thematic. As I mentioned, October was when this began. And we're only at the start of December. But we like to do that at Smartkarma. We like to be a little bit early so that we can have a longer dialogue and get to understand the theme a little bit better.
And Mazda has EV in its portfolio. So given the stock price, I have no idea, but it looks dirt cheap given the fact that it has a complete portfolio, which is not appreciated by the market. That's what you're saying, right?
Yeah, I mean, actually, the charts for a lot of the Japanese autos are similar. Mazda is just peculiarly, like, is just a little bit more depressed than the rest, but they all are. Nissan is 1.5 times book. Even Toyota is below book. I mean, that's insane. Toyota below book is a joke. Anytime Toyota falls below book, it's already a buying opportunity, given just how dominant that business is. And, these companies know how to sell in emerging markets. I don't expect a Tesla to get 50% market share in Thailand tomorrow, for instance, but Toyota can. And I think they're sitting with that distribution, they're sitting with that brand, they're sitting with after sales service, and they're sitting with technology, and they're sitting with great valuations. I mean, to me, that's an investor's combo, right? But they're out of favor. That's the opportunity. And I think over time, people will understand this, and that's when the stock prices will move. Also, a lot of the Japanese automakers have US listings. So US investors find it quite easy to invest in them when the tide turns. So, I think that could be a very interesting way to have an early start into the hydrogen economy, also play the revival of global growth, and further consolidation. So, for example, Mazda, Toyota might just increase their stake or buy them out. A $3.8 billion market cap for Mazda is nothing. Cool, guys. This was fun. And look, please don't be shy in asking questions, sending them early, contacting me. I think the whole idea with this forum is that we get to know each other better, and we delve a bit deeper into some of these ideas. And also you get to understand how to use Smartkarma better and the various features that exist here. And please, ask your friends to join us, not in this forum, but for other webinars, or, sign up, whatever it might be. We want to democratize access to institutional quality research. That's our mission. That's my mission. And you guys can be our evangelists. So that's it from me for this week. Just one little trailer into next week's forum. Next week, we're going to present a very compelling idea around cryptocurrency. An old economy business that is extremely leveraged to cryptocurrency and trading at just 3 times earnings. So that will be one of the ideas that we will feature. And that also goes to show the variety of research that we do. But that's it for this week. Thank you. Bye-bye.